Hey, welcome to the Infinite Banking Concept, How to Become Your Own Banker presentation. So this is a Tuesday webinar I do every Tuesday at 6 p.m. Eastern. So thanks for being here. If you're new on the call, if you've been here before and just kind of trying to, familiarize yourself and learn more, then welcome. So I encourage you to ask questions. So if you could just put your questions in the Q&A box or in the chat box, I'll answer those as we go here this evening. But essentially what I'm going to do is I'm just going to teach you exactly how to become your own bank. So the question becomes, why would you want to be your own bank? And for me, something I've studied for almost 15 years now is money, how money works, how money flows, investments, business, and different ways to really accelerate your path to financial success. And we do that by teaching you how to take back control of your money and solve your money problem. We do that through a couple different strategies. So for example, when it comes to money that's qualified funds, so this is money that's in a retirement account. So something like a 401k or an old 401k or an IRA or a Roth IRA or a SEP or a Simple or HSA or all these different types of qualified retirement accounts. Well, what we do is we teach you how to control that money through self-directed investing, self-directing that money into investments that you control and growing your wealth, either tax-free or tax-deferred that way. And then for everything else, we talk about, running the money through your own banking system. And the reason we want to do that is to stop making the banks rich and start making you and your family rich, plain and simple. Because do banks know how to make money? Absolutely, right? Banks are in the business of making money. And the banks do that through making spreads. Banks do that by taking your money and lending it out and making money on those spreads and by constantly keeping money moving. So we're going to mimic what banks do. We're going to do what banks do, and we're going to turn you into your own bank so you can make you and your family rich instead of making the banks rich. And that's the basic concept of this. Because if I asked you right now, what if you had a bank and you had your own ATM? And you go to that ATM this year, you deposit whatever amount of money you want to deposit, whether that's $20, whether that's $20,000. But you would deposit that $20,000 or $20,000 and you immediately pull out $30,000. And then the next year you go and you deposit $20,000 and now you pull out $35,000. And then you deposit $20 and you pull out $40,000. And each year the amount is more and more and more that you're able to pull back out of your own bank that you're depositing into it. So if I asked you that question, how many of you would like to have one of those ATM machines that you can deposit money into each year and pull more money out? How many of you would want one of those ATM machines? Probably everybody. And if you had an ability and an option to not only have one of those ATM machines, but have a handful of those ATM machines, have 6 of them, have 8 of them, have 10 of them, have 20 of them, have 25 of them. How many of you would like to have a bunch of those types of ATM machines? Absolutely, right? Who wouldn't? And that's exactly essentially what I'm going to teach you to do right now. By creating your own banking system today, you're going to be able to own and have these ATM machines essentially for the future for your money. And so if you like the sound of that, that's exactly what this is all about. So this is what we call the Money Multiplier, mapping out the millionaire mystery. Again, my name's Stephen Nagy, my cell phone and email address. I'll give you guys that stuff a little bit later. So how did I learn about this? How did I learn about the infinite banking concept? How did I become an expert and professional in accelerating your wealth growth, accelerating what you're already doing? Well, it's come from a lifetime of studying this stuff. So out of college, I was a financial planner, worked with Ameriprise Financial for a couple of years. I learned the traditional way of investing and what financial planners and financial advisors do, learned a lot about the stock market and what traditional investing looks like. And then I was introduced to Robert Kiyosaki and Rich Dad Poor Dad and that investor mindset, that business owner mindset. And I started getting into real estate investing, and I started learning more and more about investing and entrepreneurship and business ownership. And eventually I got to the point where I was doing more with my own investing, where I wanted to focus full time on doing that. So I let my financial advising practice go, let my Series 7 license, my Series 66, my 215 variable annuity, let all that stuff go because I wanted to never go back to that. I knew I wanted to be an investor, a business owner, and I knew what I wanted to focus on in life, and I knew it never involved that. I decided to let all those licenses go and trudge ahead full steam ahead. And so I've been doing that now for the last 14 years. Now, over that time, I've had many mentors, many people in my life that have taught me new subjects, that have partnered with me on investments and deals and businesses, and that have allowed me to just constantly learn something new, go out there and do it. And then what I do additionally on top of that is I then will go out and I'll teach it to other people. So I'm a big fan and big proponent of not only doing something, but then also sharing it with other people. I think there's just a part of me that I really enjoy working with other people. I like being able to share this stuff. And you know, when somebody that I teach this to comes back to me in 6 months and a year from now and 2 years from now, whenever it is, and they tell me and they tell me about how it's changed their lives, how it's changed their families' financial futures, you know, there's a lot of joy in that. That comes to me also. So not only financially does it make a lot of sense to do what I do today, but you know, from a fulfillment side, it's a beautiful thing. So I've had a lot of mentors over the years that have helped me. So I like to help mentor other people. Some of the most recent mentors in my life, Brent Kessler. Brent Kessler is the owner and founder of Money Multiplier. He's my broker for all of this and my business partner, as well as Chris Nagy. If you're on here right now, you probably know Chris. And Chris is my business partner in Money School and Private Money Club and the Money Multiplier and everything that we do. And just an unbelievably hardworking and honest guy. And when it comes to business partners, you're not going to find a better business partner than Chris Nagy. The work ethic, the honesty, the trust, the experience, it's all there with Chris. So absolutely love what Chris does and what we do as a company and as a team. And if you don't know Brent or Chris yet, definitely jump on our webinars. I mean, we do 6 webinars every single week where all we do is talk about money and opportunity, the markets, what's going on right now. This is important stuff because when you start getting into financial education, you're going to learn it all, but then you're going to forget a lot of it, or you're going to go against, you know, the traditional way that people look at money, which we're going to talk about here today a little bit. But the way to overcome a lot of that stuff is just be around it. Surround yourself with successful people. Have you ever heard of like your net worth equals your network? It's so true. Your network, the people that you have around you. You know, if you take, they say, if you take the 5 people you spend your time with, the net sum of those 5 people, the gross sum of those 5 people are going to equal where you are right now in life, whether it's financially, whether it's business, whether it's just your relationship with the people in your life. But that's what they say. And the more I kind of look at this stuff and study the stuff, the more it does hold true. I mean, would anybody on here agree with me on that? Does anybody have negative people in your life? You're kind of trying to like, hey, like, I love you guys, but you gotta cut out the negativity. You can't keep telling me no, things can't be done, because I know it can be done because I'm doing it. Because I'm seeing people that are in my life doing it. And that's what it's all about, is helping each other. And ultimately becoming that 5%. And you know, the 5%, it doesn't have to be a money thing. It could be just your lifestyle. It can be what is important to you. But, you know, if we look at it from a financial standpoint, the Social Security Administration tells us if you take 100 people at retirement age, only 5% are going to be financially successful enough at retirement to actually retire, which leaves 95% of Americans in this country not able to retire the lifestyle and financially secure in a position that they want to. So they're going to have to continue working. They're going to have to become more risky with their investments. They're going to have to cut back their retirement and not live the retirement that they want to. And as a financial advisor, I saw this firsthand with people every single day. And it's one of the things that led me to wanting to become a business owner and investor on my own, because I knew there was a better way out there of doing things than what I was telling people through being a financial advisor. So, you know, we talk a lot about this stuff in our webinars that we do every single week. So what I wanted to do was get you guys the schedule for those webinars, because it's important you hop on this stuff. So in the chat box right here, or on the screen, it's Money School REI/Snagi. So if you go to that website right there, put in your information, you're going to be able to schedule a call with me, but it's also going to send you a couple free books. I wanted to give everybody on the call a bonus, a couple free books for being on here. So I'm going to give you the books at the bottom here. And these are all great books I would recommend, but the 2 at the bottom, Mapping Out the Millionaire Mystery and the Private Money Guide, I'm going to send you guys those for free just for being on here right now. So all you got to do is go onto that site, put in your information, and I'll send you a bunch of resources, the schedule for the webinars, and then those 2 free digital books as well. So check that out. So again, just about myself, been doing this for a while. I'm an open book. So if anybody wants to learn more about me or what I do, please ask. And when we talk, schedule a call with me and we'll kind of talk through this stuff. Here's a question that I would like to ask everybody on here right now, and put it in the chat box. What do you think on this? Can you make money earning 4% while paying 6%? What do you think? Just in the chat box, just put yes or no on that. What do you think? Can you make money earning 4% while paying 6%? What do you think? All right, so I see some messages, some chats coming in. Yes, yes, no, no. Brad said yes because I've listened to you before. Yeah, absolutely. So if you've seen this before, then you kind of know where I'm going with this. But so what I'm showing you here kind of sets up the premise for what we're going to do as far as making spreads and how we're going to do what the banks do. Yeah, so Scott says yes if the assets are appreciating. Absolutely. So what this means basically, just a quick example. If we take a car loan, think about what a car loan is. A car loan is a depreciating balance loan. So the $25,000 balance starts at $25,000. Let's say a car loan that was 5 years long at 6%, so 60 months. But what happens is each month you're going to pay $483 to that car payment. Each time you make a $483 car payment, it's going to reduce that $25,000 balance. So each year you're paying 6% on the balance of that loan, but the balance is lowering each year. So each year you're paying 6% on a lower and lower balance. So just because it starts at $25,000, it's going to be lower and lower each year. So by the end, you're going to have paid about $29,000 in interest, or as we could say it another way, the bank will have earned about $4,000 in interest. And then if we look over here at a compounding loan, so if I had a savings account, for instance, that paid me 4%, and I put my $25,000 in that savings account, and that money grew each year for the next 5 years, 60 months at 4%, that money is actually going to grow to be just over $30,500. Why? Because that $25,000 each year increases. So each year that money increases, that 4% is now compounding on a higher increased balance. So this year it's 25, but next year it might be 26, where the car loan, this year it's 25, but next year it might be 22. Does that make sense? So, but at the end of the day, we actually make over $30,500 or over $1,500 paying 6% while our money's earning 4%. And the reason that I bring this up right off the start is everything that we're going to do with the vehicle we're going to use for the infinite banking concept to become your own bank works off of this concept right here. It works off of simple interest versus compounding interest. So keep this in mind as we get going through this. And I just wanted to set that up for you right now. So what is the money multiplier method? It consists of 3 parts. The machine, which is the vehicle that we use. The marathon, this is going to take time to get going. But like I said in the opening example with creating your own bank, when you start a business, are most businesses super profitable immediately? No. Well, if you're starting your own bank, let's look at it as a business. It's not going to be profitable, so to say, in the first year. You're going to get into a profit starting in like the second, third, fourth year. But then from that point forward, imagine if you had a business that was guaranteed to be more and more and more profitable every single year for the rest of your life. Well, that's what this is. It's a marathon. So it takes a few years to get going and become efficient. But once it is, thanks to the compounding interest that I was just talking about, it's guaranteed to be more and more profitable every single year that you have this thing. And this is a whole life bank. So you're going to own this thing for the rest of your life. And I'll talk about that in just a second. And if you use this machine the right way, and we're in for the marathon, then we're going to talk about becoming the millionaire. And not only becoming the millionaire, but becoming the multimillionaire in ways that we can use this thing to invest and really create wealth for you. So those are the 3 basics of what we're going to talk about when we talk about the money multiplier method. So what is the machine? So plain and easy, the machine is a dividend-paying whole life insurance policy from a mutually owned insurance company. So the reason we use a whole life insurance policy as the machine to become your own bank, it's because it's the only vehicle that exists in the United States of America that allows us to put our money somewhere, simultaneously use that money, but all that money that we put into it is going to compound and grow uninterrupted, guaranteed for the rest of your life, and create that perpetual ATM machine banking system that I was talking about before. That's the reason we do this. And that's the reason we use whole life. It's the reason I am a licensed life insurance agent to be able to create these policies for you. It's the reason that the Money Multiplier is a brokerage. So if what I tell you here tonight makes sense to you and it's something that you want to implement into your life, then you're going to come to me, schedule a call with me so I can design this vehicle for you properly and I can get you started using it the right way. Fair enough? Now, just to know, I don't charge for any of this. I make a commission directly from the insurance company. So I make a direct commission, but I do make a hugely reduced commission. So I make about 60 to 90% less than what a normal whole life insurance policy would pay me. But the reason I'm willing to give all that commission up is because this is the only way I can design the policy properly for you to get full advantage of it. Because you're going to be able to put money into this whole life policy today and immediately within 30 days, pull almost all that money right back out to use it. But it gets it in there and it starts that uninterrupted compounding interest. And so we use this whole life insurance policy because it's the only vehicle that allows us to do all of that. And so just to give you a quick example of that, if I asked you today, and keep in mind, this is guaranteed. So a whole life policy is not even considered an investment. But if you were putting your money into an investment, if you were starting a business, what are some things that would make a perfect investment or a perfect business? And if I asked you that question right now, and you guys start putting it in the chat box if you want to, and I'll kind of lead the way and put some stuff in there, but what would a perfect investment look like for you? Would it be guaranteed growth? Would you have access to the money? What else? What else would make a perfect investment? Tax sheltering, love it. Tax sheltering. How about tax-free growth? Would you be okay with that? Stability, Brad said. Absolutely, stability. So all these things that we're listing off, all these things that we're talking about right now, whole life insurance built and designed the proper way, like me and my team do, accomplishes every single one of those. It's guaranteed stable growth. It's tax-free growth. It's uninterrupted compounding growth. Even when you pull the money out, it's still compounding and growing for you, but you have access to that money immediately to pull out and use for other investments. So this is all stuff that whole life allows us to do when we design it and create it properly. So much so that, have you ever heard of something called BOLI, bank-owned life insurance? So much, whole life is so, and protected. What about that? How about protected? Put that in the box. Protected. What do I mean by protected? Protected against bankruptcies, protected against debtors, creditors, lawsuits. In most states, whole life insurance is protected against everything. It's private. It doesn't need to be reported anywhere. What you own is private. You don't need to tell anybody that. So this is all stuff that whole life allows you to do. So if we look at banks, what do banks do? We mentioned this earlier. Let's mimic what the banks do because the banks know how to make money. So let's become the bank. What do banks do with their money? Banks put over 90% of all their M1 money supply in two places. Number one, whole life insurance. Banks are the largest purchasers of whole life insurance in the country. Why are they buying so much whole life insurance? All of the reasons that I just listed out right there. Number two, banks put their money in real estate. Think about where real estate is. Real estate's all over the place. So what we're able to do is put our money in this whole life insurance, pull it out, and then invest in things like real estate. And that's exactly what I'm going to show you here in just a second, how we can start doing that. So that's exactly what we're going to do. We're going to use whole life in a way to create your bank because of all those reasons right there. So if we look at, what banks do, and you don't have to take my word for this stuff, you guys. I mentioned before, the way banks make money off of how banks make money is off of spread, right? So if we think about it, you take money and you go to a bank and you deposit money at a bank, they take that money and they immediately start moving that money, right? So let's say they pay, again, this is a magic bank, but let's say they pay you 4% in a savings account and then they give somebody a mortgage at 7%. Well, what did that bank just do? They paid you 4, they're making 7, they're making a 3% spread. They're making money off of your money. They take your money, they pay you 4% in a savings account, they give somebody a loan on a car note at, let's say, 8%. Now they're making a 4% spread off of your money. So this is what banks do. So if you really want to learn about what banks do, what I would recommend is going to this website right here. It's called BauerFinancial.com. And BauerFinancial.com studies banks, but BauerFinancial.com tells us that banks make between 400 and 1,300% off of all the money that you leave at that bank. So my question to everybody that's on right now is, why do you keep making the banks rich? If you could put your money into your own bank and make this kind of spread and returns off your money, then why would you not do that? And usually the answer is, well, nobody's ever taught me how to become the bank yet. So that's exactly what I'm teaching you right now. We're going to use that specially designed and engineered whole life policy to exactly do this right here. Make these spreads. So stop making the banks rich. Are you guys okay with all that? All right. So when we look at this thing, we need to look at ways that we can start using this. Fair enough. And so all we're going to do is we're going to change where our money goes first. So by creating your own bank and using whole life this way, we're not working any harder. We're not working any longer. We're not taking on any more risk. We're just changing where our money goes first. And so the best way for me to show you where our money goes first is to show you how most people spend money. So think about this for a second. If I was to take a dollar bill and I was to analyze where every dollar that we make goes, on average in this country, every dollar that somebody makes, 20 cents of that dollar goes to an automobile. 30 cents of that dollar goes to housing. 40 cents of that dollar goes to everything else, food, travel, kids, whatever it is, which leaves us with 10 cents at the end of the day that goes to savings. And that's how the average American earns money, spends money, and saves money. So if every dollar that we make is going to everybody else first, and then what's left over is going into our savings, to me, that's backwards. Because are you important? Nobody cares more about your money than you do. So why are we giving it to everybody else first? So let me show you how it would look if you were the bank and you do what I do, okay? So for every dollar that I make, instead of going to everybody else first and what's left over goes into savings at somebody else's bank, well, every dollar that I make, I'm going to try and put as much as I can into my own bank. And then by doing so, let me show you what that looks like. So in doing so, I'm going to start with the money going to my bank first, the savings. And then I have an automobile. However, did you know that on average, 20 cents of every dollar that goes towards the automobile, 5 cents of that 20 cents goes to interest? And where does that interest get paid to? Somebody else's bank, whether it's Ally Financial, whether it's Wells Fargo, whether it's BMW or Toyota or Honda, it goes, so that 5 cents is going to somebody else. So what if instead of having that dollar go, that 20 cents, that 5 cents go to somebody else, what if I was to have my own bank finance that automobile, and then all of that interest now goes to my bank? What if I start recapturing this interest that's going to everybody else into my own bank? What would that look like? So let's do that. So let's take that 5 cents that's going to somebody else's bank and let's put that back into my bank. And by doing so, what did I just accomplish? I just increased my annual savings by 50%. Because if I was saving 10 cents before, and now I'm saving an additional 5 cents a year that I was giving to other people, well, that just increased my savings by 50%. So let's keep going with this. Did you know on average, 25 cents of every 30 cents that goes to housing goes to interest? Yes, you heard that right, 25 cents. Banks get 90% on a 30-year fixed mortgage in the first 7 years. They're going to get the majority of their interest paid. People move or refinance on average every 7 years. So the bank's getting that money all up front one way or another. So they're getting that 25 of every 30 cents in interest paid to them. And that's how they're able to do that. So what if we take that and put that into our own bank? We just increased another 25 cents of our savings instead of somebody else. And then at the end of the day, 5 cents of every 40 cents for everything else goes to interest. So let's recapture that money also. So now by just changing where our money goes first into our own bank instead of somebody else's bank, we now are able to increase our annual savings, not working any harder, not working any longer, not taking on any more risk. We're able to increase our annual savings from 10% to 45%, just like that. So that's what that would look like. So that's what we're going to do is we're just going to start putting our money into our own bank first. So how do we start doing that? So let's take a look at this. Let's take a look at this vehicle. Let's take a look at under the hood of this machine. So over on the right-hand side is what's called a life insurance illustration. So we have the policy year, we have the age of the individual, we have the amount of money going into the thing each year, which are known as premiums. So I just want to hit a couple things on this. First off, the premiums that are going into this policy each year, you decide how much goes into it. So this individual, 26 years old, they wanted to put $10,000 a year into it. How much do you want to put into it? So as a guideline minimum, what I would recommend is 10 times your age on a monthly basis or more. So if you're 39 years old, 390 bucks a month. If you're 50 years old, 500 bucks a month. If you're 25 years old, 250 bucks a month. So that amount or more would be a good starting point to put into a policy. Now you can pay into it, the deposits, monthly, quarterly, biannually, or all up front each year. That's completely up to you. That can change anytime as well. But you're going to decide how much goes into it. And then if you want to put more into it up front, for example, like the first year, let's say you got $50,000 sitting there, but maybe you only want to put $5,000 a year into it moving forward. Well, we can do that for you. We can design and engineer this policy to fit your specific needs, goals, and financial situation almost any way we want to. So that's it right there. Again, there's no sale here. I'm not selling you anything. You're never going to pay me a dime for any of this stuff. Actually, it's all free to you. But I want to talk with you so we can talk about your situation. Fair enough? All right. So that's what those deposits are. And the reason we call them deposits is because, yes, it's a whole life insurance premium, but remember, this is your new banking system. So if you have a car insurance premium, you're like, I don't want to pay that thing every month. But if you make $50,000 on a real estate deal and you go down to the bank to deposit that money into their bank, you're excited about it, right? So if I'm putting the money into this whole life policy, even though it's a premium, if I'm depositing it into my new banking system, then why would I not get excited about that? Well, I do get excited about it. Anytime, whenever each year, whenever it comes around and I put my premium deposits into my policy, I love it because my policy is growing by that much more every single year. So I get excited about it. So from this point forward, I want every single one of you, they're no longer insurance premiums, they're deposits into your new banking system. Can all of you do that for me? Fair enough. Also, age doesn't matter. This person's 26. We can do them on 6-month-olds, 5-year-olds, 20-year-olds. If you get up in your 80s, late 70s, it might become a little bit more difficult. If you don't have the best health, if you just had cancer or something, and you things like that, unfortunately life happens. And so it's still not a problem. You can actually still own a policy, control it, deposit the money in, use it for all this stuff I'm getting ready to show you. We would just put it on somebody else's life. So we do have solutions for that also. And then again, the death benefit is there. It will pay out to your beneficiaries tax-free. It is a wonderful thing to have attached to it, but we're not doing this for death benefit. We are doing this to use it now for the reasons that I'm going to show you here in just a second. So let's get into that. All right. So how many of you would like to be able to use one of these life insurance policies, becoming your own bank, to get back all of the money for every car that you'll ever buy, drive, and own in the future? How many of you would like to do that? All right, so this is that same life insurance policy. I just showed you that, the illustration, but this is what we call a car recapture map. And we'll set this up for you too, but let's use this as an example. So this is the policy we just used. So $10,000 a year going into it in the third year of the policy of owning this thing. He decided he wanted to buy a $25,000 car. So if you were to buy a $25,000 car, you could go down to the bank, get a loan. Now that interest, just like I showed you in that example a minute, all that interest is going to somebody else's bank, making them rich. So we're losing that. If I was to go buy that car with cash, now that $25,000 that could have been making more money for me is now gone forever. I'm never going to get that money back. So my opportunity cost by buying things with cash is gone. So what are my alternatives? I can lease the car. That's pretty much like renting. All that money's gone. So my other alternative is to use my own bank to buy that car. And by doing so, I'm going to show you right now, you're going to recapture every single dollar you spent to buy that car. So here's how it works. We buy the car $25,000. Now, just like if you were to take a loan from somebody else's bank, you would pay that bank back as well. So if I take a loan from my bank to do something like purchase a car, well, I'm going to pay myself back. You okay with that? It's what we call being an honest banker. You're going to treat your bank's money just like you would treat someone else's bank's money. The difference is you're in complete control. So how much you repay yourself back is up to you. What you charge yourself is up to you. If you decide to just not pay yourself back, that's perfectly fine. I don't care. You're in charge. It's your bank. If you get in a financial situation with Ally Financial and don't pay them for a few months, or BMW, they're going to come repossess and take your car away. If I do that with my bank, I'm going to cut myself a break. I'm not going to repossess my own car. That's the biggest difference, right? But let me show you. So we take a $25,000 loan and then we recapture the money, $500 a month, $6,000 a year back into our bank. So at the end of 5 years, we put $70,000 in. We took $25,000 out. We recaptured $30,000 back in, paying the loan back to ourselves. So a net injection of $75,000. Now, cash value of the Money Multiplier account. Over here is how much we have in our bank account, in our policy account, available to use. Remember, all the money is in there compounding, and this is the amount that we have available to use. So let's just recap what just happened. We put $75,000 in. We own a $25,000 vehicle, free and clear, paid for. You have no car note on it. It's paid for. And we have $67,000 in our bank account ready to go for the next use. So I didn't recapture all of the money. Now, if I sold the car, I would have, but let's just say I kept the car. I recaptured 91 cents of that vehicle back into my bank account. So not bad. But I told you a second ago, I showed you to recapture all of the money while still keeping the cars. So here's the best part is this is a whole life policy. So it never stops compounding and growing for the rest of your life. So look over here. The cash value of the Money Multiplier account, again, this is basically your new bank. So in the 8th year of this thing, we take another $25,000 out to buy another car. Okay. Now, over the next 5 years, we're not going to put any more money into our account, but look at how our account grows each year. We are going to recapture the money just like any other bank would. But look how the money in the policy grows over here. So from the 7th year to the 12th year of this policy, we put no new money into it. We recaptured 30,000 of the 25,000 for a total of 5,000, but it grew by $23,000. We put no new money into it. This occurred through that uninterrupted compounding interest. Notice, even when I took that $25,000 out to buy another car, that money still was over there compounding and growing for me in my bank. So just to recap what we now have, we've put a total of $80,000 into this. We have $91,000 in our account, more than we ever put into it. And we have $50,000 worth of vehicles sitting in our driveway that we can sell, that we can drive, that we can Uber out, that we can Toro out, that we can do whatever we want with. But the bottom line is if it looks like to me, I bought $50,000 in cars, I have $91,000 sitting there, I've recaptured every single dollar to buy those cars, I've now recaptured back into my financial life. Now to do this, we got to follow 3 rules. These are the 3 rules of infinite banking, of being your own banker. And I'll show it to you on here. Always pay yourself first, always pay yourself with interest. Again, treat your money just like the bank's money, and always recycle and recapture your money. So be an honest banker. You're in complete control of those terms, but smart to recycle and recapture that money. And guess what? If this works with a car, what else can it work for? Any real estate investors on here, maybe major purchases, things like roofs, kitchens, maybe just for your house. Maybe you want to build a pool. Maybe you want to buy a boat, an airplane. You know, what other kind of major purchases that you could use your bank for, recapture all of that money and basically make money making purchases. That's exactly what I just showed you and exactly what this thing will do for you. So one more example. Do any of you have debts on here? So this was a chiropractor. This chiropractor made good money, but he also liked to spend money. And he found himself in a position where he had $478,000 in debt. So Ranjit said, so we are paying that car loan, the $6,000 as well as the $10,000 annually. Yeah, that's a good question, Ranjit. So the loan repayments is always going to be separate of your annual deposits. All right, so this was, so what we did is we did the map for this chiropractor, and he was paying $70,000 a year in third-party debt to all of these third-party debtors, almost $5,800 a month. So we did the math. It would have taken him 19 years to pay all this debt off. So he said, let us show you how to do this, becoming your own bank, using a specially designed whole life policy to do this a lot faster. So he started a policy. He was comfortable doing $25,000 a year. So he puts $25,000 in. He has just under $15,000 available to take out of the first year to use. If you're an investor and you want to have access to more of that $25,000 or whatever amount is that you decide to deposit in, we can build this for higher cash value now and get you access to more money quicker. But in this case right here, they had $15,000 available in the first year when they put that $25,000 into it. So we pulled the $15,000 out. We paid off the Discover card, paid off the Lowe's card, and paid down the Nordstrom card. So you'll notice over here, instead of $5,700 a month going to third-party debtors, $5,300 a month is now going to third-party debtors. And $448 a month, the $161 and the $787 that we were giving to Discover and Lowe's, what are we now going to do with that $448 a month? So we no longer have to pay Discover and Lowe's because we paid those off using the policy. But what are we going to do with that $448 a month? So pay close attention here, because I'm going to teach you how to start actually becoming your own bank. So what you're going to want to do is you're going to want to create a separate checking account, what we call a segregated bank account. And this separate checking account is going to be just used as like an intermediary for like a holding tank for your banking system. So what happens is when we take that $15,000 out from the policy, it's going to go into that segregated bank account. And then we're going to pay off Discover, we're going to pay off Lowe's, and pay down the Nordstrom card from that bank account. And then what we're going to do is that $448 a month, instead of paying Discover and Lowe's each month, we're just going to set up an auto pay to start paying our segregated account back. And then the money's going to sit and build within there. And you're going to see in just a second why we do that. So again, we're not doing anything different, but instead of giving that money to third-party debtors, we're now taking a portion of it and we're paying it back into our banking system. And you're going to see how each year that's going to increase more and more. All right, so pay attention. Year 2 of this policy. $25,000 goes in, cash value $16,500 that year. You'll see it's a little bit more. And each year that amount's going to be more and more and more. And then we have the payments, recaptured payments of $5,300. What is that again? Well, that's that $448 a month going into that segregated bank account that built up throughout the year. So we now have that available to use as well. So we have the $16,500 in the policy, and we have the $5,300 in our bank account, a total of $22,000. So what do we do with that? Well, you guessed it. We take that $22,000, we pay off the Nordstrom, pay down the Wells Fargo, pay off the private loan, and pay down the BMW. So now we have $1,900 a month that was going to third-party debtors. That's now only $3,860. That $1,900, same thing, right back into our segregated bank account. Year 3. Same thing, 25 in, 25 available, 23,000 in recaptured payments, a total of $48,000. Pay off the BMW, pay off the West Marine, pay down the condo, 3,600 in payments going back to our segregated account, and only $2,100 going to third-party debtors. So let me make sure you're following so far. Please answer in the chat box. So far, we put in $75,000. And we took out $55,000 to pay off debt. So if we put in $75,000, we took out $55,000, how much is still in your specially designed and engineered whole life policy, otherwise known as your new banking account? How much is in there? We put 75 in, we took 55 out. How much is in there? What do you think? All right. So if those of you that are saying $75,000, I love it. That just means that you guys are following perfectly right now. So the $75,000 is still in there. I just wanted to make sure you're paying attention. So remember, When we put the money in, it's going to compound uninterrupted for the rest of your life. The way that happens is when we take money out of the policy, use it for this stuff, buying cars, paying off debt, investing, we're not actually taking our money out. We're borrowing from the insurance company's general account. We're using our money as collateral, and it comes out in the form of a loan. And that's what allows the money to stay in there compounding uninterrupted, even when we take the money out to use it. So thank you very much. Just wanted to make sure you guys are following. So year 4 of this, 25 goes in, 26 available, 44 in payments recaptured. Year 5, same thing. Now, year 6 of this policy, something happens. Year 6 of this policy, they no longer, on the left side over here, they no longer could put $25,000 in. They hit what's called the MEC limit. So when we design and build a policy for you, however much you're going to put into it annually, at some point that amount is going to drop. Whether it's the 6th year, whether it's the 8th year, whether it's most times these days, it's the 11th year, but that amount's going to drop a lot of times from 25 to 10, from 25 to 5, whatever it is. And now that becomes the most you're able to put into that policy from that point forward. So what happens whenever you want to start putting more money in to grow your banking system, you don't want to put less money in. So the way that we do that is you can't put in that existing policy, but you can open up additional policies. So you can open up additional policies on yourself, on your spouse, on your kids, on your business partners. You start opening policies on other people, and that's how you, or more on yourself, and that's how you start growing your banking system. So this chiropractor now has one policy he's now putting $10,000 a year into, and a second policy that he starts out putting $25,000 a year into, and that amount will drop eventually as well. First policy, he puts $10,000 in. Remember, it's the 6th year of this thing. He now has $13,000 increase in cash value that year, a 30% cash on cash increase in the 6th year of this first policy. The second policy he puts $25,000 into, but he only has $14,800 available to pull back out. Why? Because this second policy, he's starting over in the 1st year of that thing. And remember the marathon, it takes a few years for the policy to become efficient, where you're pulling out more money than you're putting into it each year. But again, once that happens, the amount comes more and more and more every single year for the rest of your life. The max you can put into it, Ahmed, depends on your financial qualification. So if you're worth a lot of money and you make good money, we can do, I think, 3 million without having to get special approver. Anything over 5 million, we just have to get the insurance company executives involved, which is no problem. I have them all on speed dial, so we can get almost anything approved for you that you want, no problem. And we do 7-figure a year policies with people, so it's no problem at all. In the 6th year of this policy, we now have enough money to pay off all of the debt. So in 6 years, that would have otherwise taken 19 years. We have now paid off all third-party debt. So now the $57.77 a month that was going to third-party debtors is now just going back to he and his family's financial banking system. So all that interest is now staying in their financial lives for the rest of their lives. In 6 years, we were able to do that. And if you like the way that we did that, we are going to do the exact same thing with you also. So this is what we call a debt map. So not only do we design the policies and create the policies for you, once you have the policy and you start, and it goes what's called in force, and you fund it for the first time, you go directly over to what's called our mapping team. And our mapping team is going to teach you how to start using it. So immediately take that first loan. If you have debt, we'll do a cash flow analysis and we'll create a debt map for you on how to tackle that the quickest way possible. If you want to use it to buy a car, let's create that recapture plan and create the banking system so you can recapture that money. Or if you want to invest with it, put it into a business, we'll create that cash flow for you and how that money flows. And I'll show you a couple examples of what that looks like also right now. And when it comes to investing and building wealth, I mean, there's really unlimited ways to build wealth. These are some of the things that we focus on and teach in some of our other webinars and our money school trainings. This is all stuff that I personally do. So a lot of real estate investors, whether that's commercial, multifamily, single family, flips, wholesaling, rental, short-term, long-term. We do a lot with private funds, private lending, note investing, Even crypto, startups, businesses, stocks and options. I mean, all different ways that you can create wealth. But what I want you to start thinking about is, how can I take what I'm doing now with this investing, but flow the money through the policy first? So now we have that uninterrupted compounding interest and is simultaneously pulling the money out. And if you're an investor, you're in real estate, business owner, something like that, just let me know and I'll create and design a very high cash value policy for you. So you can take almost all of it right back out. I'll give you a couple examples. Here's a high cash value real estate policy I did. So they wanted to do $150,000 the first year and then $50,000 a year after that. So you see over here the premium. Again, they're not premiums. So what are they called? Deposits. So 150 goes in. Look at this. They have 132,000 immediately to pull back out the first year of that 150. Look at this. The fifth year, they put 50 in, they're pulling 56 back out. But look how fast that thing increases, the increase in net cash value. Look down here. Look in the 12th year of this thing. They put in $17,000. Look how much they have available, $47,000 to pull back out. That's a $30,000. Remember I asked you earlier, what if you had an ATM machine? Well, in this example right here, look at this ATM machine. They put $17,000 into it and they can immediately pull back out $47,000. The next year, $17,000 into it, pull $49,000 back out. The next year, $17,000 into it, pulling $52,000 almost right back out. I mean, who would not one of these things? Did it take a few years to get to that point where you get those returns? Yes. But what is the second part of this method? The marathon. What's the alternative? Putting this money into a bank. What is the bank paying you? 0.01% if you're lucky. And if you take the money out to use it, they're paying you zero. Remember, we're putting this 150 in, this 50 in, this 50 in, this 50 in. It's not sitting in there and waiting to get these kinds of returns. We're putting the money in there, or immediately pulling it out to make using it in other investments to recapture other interest that we were giving to other people. So we're doing both things at the same time. It's not an either or, it's an and. Fair enough? Here's another one. 50,000 going in the first year and then $500 a month. So maybe you don't want to do 50,000 every year, but you want to put the 50,000 in up front right now, but you only want to do $500 a month. I'm good with that. We'll design and engineer this thing almost however you want to. So make sure you schedule a call with me so we can talk about this stuff. Again, I'll put my calendar in here. Go to that link right there to schedule a call with me so we can talk about this. And if you need help with the investing side or learning the investing side, again, we do trainings on this stuff. Join us for the webinars. Go to that link right there and I'll send you all the resources. We have things like the Private Money Club where you can start, really compounding and growing your money, where we connect borrowers and lenders and borrowers. But again, guys, this is all stuff that we do all day, every day. So I want to talk with you. So just to make sure I didn't forget anything, the death benefit is tax-free. It creates a legacy. The loans never have to be repaid. You set the terms. The internal values do grow tax-free. The loans come out tax-free. The death benefit's tax-free. We can use this for business. If you have an LLC, an S Corp, a C Corp, whatever it is, just ask me about the different uses for loans versus company-owned life insurance. I can tell you all about that as well. If you have kids, how can you use this for college planning, for cars, for businesses maybe the kids want to start? These things are unbelievable vehicles for children. Why? Because these things operate off of compounding interest. What do compounding interest work off of? Time. So the more time, the better. It's a beautiful thing. So this is all stuff that we can talk about. So I want you to think about, how much do you want to fund it with? How much do you want to put into it? And we can talk about that on that phone call. So think about this right here. Are you better off with or without one of these while you're alive? And are you better off with or without one of these things with you die? And if you answer to either of those questions is yes, to either or and, then I would love to talk with you. So all you got to do is go to that link right there. My calendar's on there. Not only we get the free 2 digital ebooks, all the resources, the webinar schedule, so you can register. Again, it's all free, guys. We don't charge for any of this stuff. All completely free. Schedule a call with me. Let's talk. I'll answer all of your personal questions. And if appropriate, I'll help you guys get started with your own banking system. So with that being said, that's all I have for you here this evening. Do you have any questions right now? If so, put them in the chat box. Otherwise, get that call scheduled so we can hop on the phone and I can answer those questions specifically for your situation. We can start planning this out for you, and we can get you guys becoming your own bank, multiplying your money, and never looking back. Because once you learn this stuff, you will never go back to the old way of banking and making banks rich. You're going to try and get more and more money into this so you can create financial success for you, and not only you, but your family and your loved ones for generations to come. This is what the Rockefellers do. This is what the Chases do, the JPs, the Morgans. This is what the wealthy do. This is what banks do. And this is what you're going to start doing right now. So thank you for joining me here tonight. I hope you learned something. I look forward to talking with every single one of you guys. And have a great day. If you're in Florida or anywhere in the path of the hurricane, please stay safe over the next couple of days. If you need anything from me, you know how to get a hold of me, my personal cell phone, my email, and my call calendar. Hope you guys have a great night. We'll talk with you soon. Thank you so much. Adios.